Okay, so welcome everyone's today's topic is how to double your income and triple your net worth. Most investors, I'm talking about over 95, don't make it to the level they could. And the reason why is because they just can't find a great deal. And yet they think it's because of money or credit, but that is not the reason. The 2% of the successful investors, they have a great deal, and that is why they can get funding, they understand basic analysis. So these are the steps that we're gonna really quickly go over. First of all, you've got to identify the right market that supports your exit strategy, because you have flipping markets and rental markets. So one of the mistakes is that people, if they want to buy and hold, they do it in the wrong market. They might do it in a flip market. So that is thing number one. And then accessing great deals. I'm going to show you what to look for. And then finally, most people go into an analysis paralysis. So I'm just going to give you quickly few rules of thumb that you've got to follow to be able to analyze deals very quickly without a calculator or a system. And then finally, some tips for you to get funding should you decide to go for the exit or the fix and flip or the buy and hold. Okay, so getting funded is so critical. Okay, so now let's dive into what you need to do. So really focus on these areas that are going to be so critical. So first of all, identify a market where you need to invest. So the sweet spot is for you to focus on rentals if you want to triple your net worth. Okay, stay away from flips or wholesales. Wholesales, let me tell you what my issue with the wholesales is. If you find a great deal, why would you want to give away the golden goose, right? So you need to keep that property. So if you have a great deal, guess what? There are going to be tons of people who would love to partner up with you. So please, if you find a great deal, you'll be able to find funding through other partners. People are going to work with you. Okay, so the key is to focus on properties, very simple, under 150,000 in B areas, or A ideally. So A are the best and most expensive. B is like the war zone. So it's focus on BA areas. Right now we're gonna disregard flips for sure. And then you need to look for deals in properties that are technically not for sale. So it's those are called off-market properties. So we're gonna be looking for two factors, with properties with a lot of equity and owners with a lot of motivation. So you need those two components. So these are my favorite lead pipes: foreclosures with high equity, and then upcoming auctions in 30 to 45 days where the owner is gonna pretty much lose the house if they don't take action right away. And finally, banked on properties or REOs. So the next thing is to analyze. This is where a lot of people, they do analysis paralysis. So I'm just gonna quickly show you all the rules of thumbs that we use that are so critical for you to analyze a deal. So in these rules, I'm gonna add one rule, which is the one that I'm gonna start with. When you look at a property and see the price, let's say they're asking for 75,000, okay? The first thing that you need to do is add $100,000 to that. And that should be your ARV, okay? You're gonna be able to pull comps within a 1 mile radius that sold in the last 6 months. That's pretty much the condition. So add 100,000. So when you add 100,000, you're accounting for a 20% net profit on should you do a flip. And not only that, but when you have that much equity, your cash flow is going to be positive, at least 200 to 300. Not only that, is going to meet the funding criteria. So banks are going to be looking for what's called the debt coverage ratio. What that means is that they want to make sure that if you keep the property, the proceeds or the income is going to not only pay for all the operating expenses, meaning what it takes to run the property, but you are going to cash flow a surplus of 20%. So if the rent is 1,000, or the operating expenses are 1,000, they want to make sure that you collect at least 1,200 in rent. So you've got a cash flow 200 at least. So now the question is, once you have that spread, so if the house is for sale for 75, obviously you're going to add 100,000. 75 to 100. I'm more inclined towards 100 to be more conservative, especially right now in the crisis, because property prices have dropped 7%. Okay, and then once you have that spread, you need to look at the condition of the property, because the numbers are going to work great if the rehab is under 40,000. Please make a note of this. If the rehab is less than 40,000 and you have a spread of 100,000 between the asking price and the ARV, your numbers, you're going to be okay. Okay, so that is so critical. And also what's so critical when analyzing the property, location, location, location. Okay, so stay away from busy streets, cemeteries, rivers, things that are going to affect your property values, train tracks, airports, and so forth, because then you won't be able to sell the property. And that's not going to be a property that might be attractive to prospective tenants. So please, that's, I'm sure, a given for you, location, 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 but I always have to emphasize that because I often find investors buying quirky houses where the location is not ideal and they want a price for what they think of, okay? It's gonna pay, so that is so critical. Now, I put some formulas of how much you need to pay for the property. So that is very, very important. So let's assume I'm gonna pull up the calculator and then show you how this formula works. So you don't need a system or anything. All you need is your cell phone. So what I'm going to do is I'm gonna give you the example of the property that I told you. If it's worth 175,000, okay, ARV, so you're gonna multiply these by 70%, okay? It's a rule of thumb. So 175 times 70%, 175 times 70%. Okay, there we go. And then you're gonna subtract the rehab amount. So the rehab, I told you, should be less than 40,000. So I'm gonna subtract 35 to 40,000. So this is your max allowed offer. You should not pay more than that amount. So you see now why by adding 100,000, it totally makes sense. You're gonna be covered in all days. Because using the 70% rule of thumb is the price you need to pay if you're going to do a flip, because that takes into account a 20% return on your investment plus any carrying or holding cost for the duration of the project. But just follow this rule of thumb. From the asking price at 100,000, that should be your ARV. Once you pull the comps, make sure that it's 175 and the rehab is less than 40,000. If you understand those two things, you are all set. Okay. So I'm going to repeat this again. Check the location. And second thing is add 100,000 to the asking price. Make sure the rehab is less than 40,000. Okay. Now to compute the rehab, a good rule of thumb is take the square footage and multiply it by 20 to 25. Okay. And that should give you an estimate of your rehab amount. So long, it's not a go rehab. So you don't want to redo systems, plumbing, electric, HVAC, roof, windows, foundation. You really want to stay away from the high ticket items. You just want to update kitchen, bathrooms, flooring, paint, light fixtures, light plumbing, light electric. You don't want to do, you're not in the business of construction, you're in the business of investing. So you need to be in and out of deals. Your rehab should take no more than 6 weeks, okay? Plus market time, maybe another month to 6 weeks, all including rehab and time, shouldn't take you more than 3 months per deal, okay? So you should technically be able to do 3 to 4 deals a year if you stick to these numbers. So now the next is if you're gonna wholesale, obviously you need to market the deal to cash buyers. So that's the target audience. We're gonna help you do that. We're gonna blast them to over 10,000 cash buyers, investors, should you decide to do a wholesale. But if you have a great deal, please try to partner up with somebody else. If you don't have the money, they'll be willing to pony up the investment, okay? And you are going to be part of the transaction, because if you wholesale the property, all you're gonna get is a wholesaling fee, 5 to 10,000, 5% of the purchase price, which is very little. And that's what's really difficult in real estate, having people identify, find, and not only that, but most importantly, get home run deals under contract. And then finally, you've got to present your deal to get it funded. So the banks are going to be looking at the debt coverage ratio over 1.2. What that means is the bank wants to make sure that what you collect in rent is going to cover the operating expenses of the property, and you're going to cash flow at least 20% on top of it. So if all the operating expenses are 1,000, you need to collect 1,200. And finally, we're going to be using asset-based lenders for the purchase, okay? Because the cool thing about asset-based lenders is that they're going to be looking at the property itself. They will finance up to 90% of the purchase and 100% of the rehab. That is why I love them. And then on the back end, obviously, we need to pay them off because those asset-based lenders, such as hard money lenders and private money lenders, are expensive. So we need to get them out of the equation as soon as we finish the rehab and get it rented. So we're going to use conventional lenders to refinance. Or some hard money lenders can put that rehab loan into a rental loan, which is awesome. Now, I'm going to show you some examples. Okay, so these are the properties that we've done in the past, and those are the numbers. I want to show you what the numbers that you should be looking at. I'm going to display all of these. So right here, this is in hometown. Okay, it's so simple. You want to stick to boring houses. So this is a 2-bedroom, 1-bath, no basement. Okay, so purchase 54, rehab only in 70. There is 115,000. So if I gave you the formula that we talked about, you buy it for 50 or 54, add 100,000 or 75. So add 75 to 100,000. So if I add 75, it comes out to 130. Well, these are priced for a little bit less than that, but yet since the rehab was so little, only 16,000, the numbers all made sense. So what you need to focus on is all in, it's 70,000, right? But how much did it appraise for? 115,000. So here, the key thing is that you have over 35 or 35% equity. So you need to aim to have 25% equity once you pay off the hard money lender and the rehab. So in this case, we had to refinance to pay off the 70,000, right? Because that's hard money, it's expensive, short term. So we tap into the equity of the ARV, we tap into 65% of the equity, because guess what? Banks want you to have at least 25% equity. In this case, we ended up with 35%. So you have just increased your net worth by 40,000. And on top of that, this is just the sugar coating, right? When you buy and hold, the tenant ends up paying for the debt, the mortgage, the principal, tax, insurance, and on top of that, you cash flow. So I'm going to give you another example. So this is in Caesar, another simple, boring house. I want to show you the numbers. So purchase price 80, rehab 20. So look at the rehab, right? Everything is under 40,000, all in 94. It appraised at 172. So let's reverse engineer the analysis. So in this case, 80 plus 100,000, that's 175,000 or 180,000. So that's how much this property appraised for, 172. So once we take the all-in cost of 94, when it comes to refinancing, they're going to take the ARV, and we're only tapping into 58% of the ARV to refinance, and then we end up with 41% equity. So this is how much our net worth has been increased by. And on top of that, the sugar coating is the rent, right? So the rent, if you buy and hold in right rental markets, which we can give you, send us an email, we're gonna give you the top rental markets, then your property will cash flow immediately. I'm gonna give you another example right now. So let me show you this. It's in Evergreen Park. So this is a slightly bigger property, but again, it's below 150,000 and the square footage is less than 1,500. Purchase price, so add 100,000 to 92. It's got a price for 192, it a price for 220. So everything is gonna work all day long, flip, rental, wholesale. Here, the only tweak is the rehab. It took 45,000, which is a little bit over what we consider light to medium. So this is a little bit on the getting started on the gut rehab, because we're touching pretty much more systems. We ended up touching all the electric and then plumbing as well. So that is why the rehab went a little bit over. Obviously, we did all the flooring, updated the kitchens, the bathrooms, but look at the numbers. When we refinance, we only tap into 63% ARV, so we ended up with 36% equity or 80,000. So this is by how much your net worth is increasing. And then again, the sugar coating is the tenant pays for your mortgage and it's putting cash flow in your pocket. So this is what I just wanted to give you a quick overview of how you can quickly analyze deals, right? Once you identify the hot rental or flipping markets, ideally rental markets that you want to stay on, to identify great deals off market, do the formula, add 75 to 100,000 to the asking price, and your numbers are going to work amazing so long the rehab is less than 40,000. Okay, are there any questions on the line? Any questions on the line? Okay, so let me pull up the chat. Okay, if you partner up.
Actually, I have a question.
Yes,
so the 80 in the equity, if you're like, if you have the ARV at 220, where versus what you went in there with?
Okay, so if you take, great question. So if I multiply, I need 63% of the ARV to pay off all-in cost, which is 92 plus the rehab, 137. So we need 140 to pay off the Harmony lender or asset base. So we tap into 63% of the 220. Okay, so we end up with a remaining of 80,000 in equity. So the bank wants you to have on the back end at least 25% equity. We ended up with 36. Does that make sense? So we need to pay off the initial investment of 137 plus closing costs 140. Therefore, we tap into 63% of the ARV. And then that's how much you increase your net worth by 80,000. So every time you do a deal, you increase it by that much. So in 1 year, you can easily do 3 to 4 deals if they are simple, less than 1,500 square feet. So therefore, imagine if you increase your net worth by 75,000 or on each deal, so 4 deals, be conservative, 3 deals, that's 200,000 a year that you can easily increase your net worth by. So let me just pull up the example above on Caesar. You see these, take the cost, 80,000, and then add 100,000. So technically, when I looked at the property, this should appraise for 180. It appraised for 172. So it's in the ballpark. And the rehab, this is critical. The rehab needs to be under 35,000, max 40,000, and your numbers are gonna look amazing. You're gonna be able not only to get funded for the deal, you will also have positive cash flow. And remember, please keep in mind, if you find an amazing, great deals, why would you want to give away the golden goose, right? So we found this for 80,000. Why would I want to wholesale and then just make 5, 10,000 on the deal, right? You want to be part of the transaction. So when you find a great deal, there are going to be plenty of people who want to partner up with you. Okay, so that is so critical for everyone. Okay, so if you, are there any other questions on the line? So I'm gonna go over the questions. I just wanna make sure this is the mechanism that we've been using to grow exponentially to 29 rentals.
Patricia is asking, why don't you tap into more equity? Someone named Patricia is asking why
perfect, perfect. Thank you for telling me the question. So the reason why we could, and we've done it in the past, because the bank wants you to have 25% equity. So we've done that. So not only are we able to pay off the Harmony lender, but we can also cash out. So we've had cases where we request, let's say 5 to 15,000 cash out. So we can use that money for other purchases. So absolutely, you can do a cash out and you don't need seasoning, which is amazing. But we just want to have as much equity in the deal as possible, because eventually the rule of thumb is to pay off these properties as soon as possible in less than 10 years. So the quicker you pay them off, the wealthier you're going to become. Are there any other questions on the line?
So Hugo, my question, this is Patricia. My question was, what would the exit strategy be if you partner with someone rather than doing a wholesale deal, since the fix and flip is not a good exit strategy right now? So how would you partner?
That's a great question. You can do a joint venture with somebody else. Do not create an entity with somebody else. Just do a joint venture. I can send you a 2 to 4 page joint venture agreement. So Everything is explained, the terms, contributions, and split of profits in a joint venture. But ideally, you don't want to partner up with somebody in rentals. Why? Because it's like getting married to somebody. You just want to be in and out, because if you don't know that person, you don't get on, then it's a big deal to be in a partnership on rental. So ideally, if you need money for the rental, just get it from a Harmony lender, pay the interest rate. It's okay, because if you have enough equity, you're going to be all good.
Okay, thank you.
No problem. Any other questions?
Hugo,
Yes.
Peter is saying that the audio isn't working and neither is the video.
Okay.
Hugo,
Yes.
I joint venturing with, I have bought 2 townhouses, but I'm going to joint venture with my broker on this. And I'm trying to find out, how do I find lenders and what's my strategy on doing?
Okay, so do me a favor. Can you send us an email to support@ChicagoDealVault.com? We're going to send you the list of lenders. We have 22 Harmony lenders, asset-based, that are lending today in this crisis. In fact, we're closing next week on a property, okay? So they're lending.
Okay, thank you.
What was that email again?
Support, I'm going to put it in the chat, or if somebody can put it on the chat, is support. I'm going to type it in, support@ChicagoDealVault.com. So we'll send you the list of Harmony lenders. We're going to send you the joint venture agreement, and we can send you also the list of top flipping and rental markets, okay? So if you want to, this is what we have, right? Access to DealVault. So that's for you to, if you want to have access to cash buyers, private money lenders. If you want to have access to off-market deals, we can give you access to all of that. So we have two plans, the monthly and the yearly. So the only difference is that with the yearly, you're going to get a lot more. Okay, so you're going to have access to dedicated virtual assistant to help you find deals. And what you can do is we have a 30-day money back guarantee. So, but I'm going to make a special gift for everyone. You can sign up today, and we're going to give it to you for free for the next 30